So as we mentioned, return inwards is any goods that have been returned to us by our customers. And the three reasons that we explained here, that we read here, we need to kind of like keep in mind just in case it comes in exams. Another reason, which is very common these days, is some companies would provide a return policy where the customers can return the goods in 30 days or 60 days without any reason. So the goods do not have to be in a bad condition or anything to be returned. It could be the seller gives the customer an option to change mind in the 30 days. This is generally a promotional measure taken by the suppliers. So this is another reason why we would have return inwards, because we are providing a return policy and the customer thus changed his or her mind and did not want the goods any longer. So that's another reason of return inwards. So when there is a return inwards, we need to think of the accounts that this would affect. Return inwards means the stock is coming back to us, which means the stock in effect is increasing by the amount of that the goods were returned. So thus, because the stock would be increasing by that amount, stock is an asset, so an increase in asset would be debited. So the return inwards account is always debited. So if you get this and understand the reasoning behind this, why you would never have any kind of like issues writing a double entry for this, because return inwards would, you would always remember, return inwards is always debited because it's an increase in the stock that we hold, the business holds. So that's one part of the entry. So if we have return inwards coming, what would be the other entry? The other entry would be if the returns, if the amount, generally the returns is only when we had sold it on credit. So if we sold somebody, like, a debtor on credit, it would have been debited initially by, maybe if we made a sale of 100, it would have been uh, debited by 100. Now what that debtor owes money to us, it would be reduced because he has returned part of the goods or all of the goods. So that means the asset would reduce. So the debtor is an asset. So the debtor, what amount the debtor owes would be reduced, which means there would be a credit in the debtor's account. So in this case, on 5th August, F. Lowy returned goods worth £29, which we had sold him initially. This means that we had maybe sold him a £100 worth of stock. So we had debited F. Lowy's account with £100. However, now he has returned back to us £29 worth of goods, which means that there is a decrease in the asset that F. Lowy was owing to us, or the asset that F. Lowy represented to us. So there would be, because there's a decrease in asset, we would credit the account by £29. So just to kind of like some of the return inwards entry, if the return inwards amount account is always debited because it corresponds to an increase in the stock account, and the corresponding credit would be either the debtor's account, which is reduced, or if we were to pay cash in exchange of the goods that we received in, we would credit the cash account. Moving on to the last entry, which affects the stocks, it is the return outwards. Return outwards, as the name suggests, means any returns that is going out of our business. This means that whatever we had purchased from our suppliers, we are not happy due to the three reasons that we explained above, which is either damaged goods or poor quality goods or the wrong size or color, or because we have the option of returning the goods within 30 or 60 days without any questions being asked by the supplier, which is very common these days, especially in retail, where we can go and return whenever, even if even if the product is in good shape, just because we changed our mind. So that's return outwards, whenever we return our purchases back to the supplier. Now, in terms of stock, what does this mean? This means that the stock account would be reduced by that amount of return outwards. So, stock is an asset account. If it was to reduce, it means it would be credited. So, in effect, or to sum it up, returns outwards account is always credited because it means a reduction in asset, which is a stock, which is the stock account. So just kind of like understand the reasoning and always keep it in your mind that return outwards is always credited. So what would be the corresponding debit entry? Because now, uh, if we kind of like made purchases of higher of £1,000 from a creditor, we would have credited his account to increase a liability. However, now the liability is reducing by the amount that we have returned, because we no longer owe the amount of which we have returned the goods. So if we return the goods of £97, our liability has decreased. So a decrease in the liability account means that we would debit the account. So here in this case, we would debit a creditor's account, which is KHOE, and we would debit a creditor's account and we would credit the return outwards account by the same amount. Here we have a few worked examples which we'll go through 1, 2, and 5th, and then you can go through the rest of it. So I'll just, before doing the worked example, I'll just again kind of revise what accounts that we have covered today. So we have covered the purchases account, the sales account, return inwards account, and return outwards account. Purchases account is always debited because it entails an increase in stock. Sales account is always credited, which because it means that the stocks have reduced. Return inwards means any returns coming inside the business. So returns coming inside the business, because it leads to an increase in stock, it is debited, and return outwards is any stock that we return back to our suppliers, returns going out of the business, and because it leads to a reduction in stock, we would credit it. So debit purchases, credit sales, debit return return inwards, and credit return outwards. So if we get all of these right, the reasoning behind why each account is credited, it our actual workings of the real examples would be made very much easy, even in the exams or in multiple choice questions when we get. So the word example, if we look at the first one, bought goods on credit 220 from D small, we'll always, whenever we read a transaction like this, we'll consider the two effects that it would have. Bought good means purchases. So one account would be the purchases account. On credit means there would be a creditor or a liability. Creditor is a liability account, so there would be a liability account. So purchases account, as we explained above, it is always debited. We would debit the account by 220, and then we would credit the small account by the same amount. So if we can look here, purchases account May 1 D small, it's debited, and if we go down D small it's credited by the same amount of 220. The second example, bought goods on credit 410 from A. Lion and Sons. It's a similar entry as the first one, so it should be simple. Again, we'll debit purchases by 410, and then we would credit A. Lion and Son, which is a creditor's account. We'll credit it by the same amount of 410. Moving on to a third one, it is a sales entry. So it's sold goods on credit to D. Hughes. Here, the two accounts that would be affected would be the sales account, because we have made sales, and because it's on credit. There's no cash involved. So on credit means there would be a debtor account, which would be an asset. So an asset would be increased by 60, which means D. Hughes, sorry, D. Hughes would be debited by 60, as we can see here. Here, D. Hughes on May 5th, he was debited by 60 because there was a sales, and in the sales account, we would credit the sales account by 60. The sixth entry is sold goods on credit to M. Spencer for 45. Similar to the entry above, we would credit the sales account and we would debit the M. Spencer account by the same amount. Now, moving on to the next entry, this can be a bit tricky. Return goods £15 to D small. Now, we have returned goods to D small. This means we first have to find out whether it's returned inwards or it's returned outwards. Because we have returned goods, it is returned outwards because the returns has gone out. Whenever there is a return outwards, it means there is a reduction in stock, so the account is going to be credited. So the return outwards account would be credited by 15. D small D small was a creditor, which means it's a liability account. So when a liability account decreases, because we have returned goods worth £15 to D small, when the liability account decreases, we would debit the account. So these